Once again, a number of seemingly unrelated but important concepts, okay? So chapter 2 is going to be showing you a couple of financial statements. We'll go over them very quickly because, our work starts once the accountant's work ends. We take some of the data at least that the accountants provide us. So when their work is done, we pick up and use some of those numbers to perform our analysis, make some decisions. So we'll talk about taxes, we talk about cash flows. Remember, we did talk about cash flows in chapter 1. So this is a typical balance sheet, okay? How I view a balance sheet is as follows. I say, this side here, I'm gonna call it the right-hand side, because it's my right-hand side. So the right-hand side is called the financing side. So if you want to know how this firm is funded, okay, this is what you need to look at. This is where the funds are coming from. You can create value by managing your financing. As I told you, borrow a little bit, your interest expense is tax deductible, it lowers your taxes, you create value. So this is the financing side. So what do we do once we have the financing? We make investments. So all your investments, fall on this side, the left-hand side. Okay, so the idea is you want to create value by raising funds in some optimal fashion. This is where you are raising funds and making sound investment decisions, and all your investments show up here. Okay, short term, long term, doesn't matter. All right, so this is how you view a balance sheet. Now, let's talk about the right hand side. There are 3 types of assets, you can say, or 3 types of investments that companies make. Okay, let me go back to the slide. Here is something that you want to know. So if you have to define, what a balance sheet does, a balance sheet, reflects a firm's financial position, what it has and what it owes. What it has shows up on the asset side. What it owes shows up on the funding side, the right-hand side. So that's what a balance sheet does at a given point in time. So there will always be a date as of December 31st, 2017, okay? As of January 1st, 2018 or 19. There are 3 types of assets: current assets, fixed assets, and intangible assets. Let's take a look. Current assets, do you remember we called current assets by different name in chapter 1? Does anyone remember what the name is? Current assets is the same thing as working capital. Working capital, okay? So life is 1 year or less, generally less than a year. So the life of these assets, what do I mean by the life? I mean, are these assets gonna die? No, they will turn over. They will disappear, Some of it will disappear tomorrow. Now, if I have to make a payment today to AT&T, so maybe a little bit of this will be gone by tomorrow, okay? Or maybe, somebody makes me a payment from here, I sold somebody some things on credit, and that payment will be reflected here, and you will see a higher cash balance. So that's what we mean. These numbers, they are fluid numbers, okay? Ever-changing numbers. And the life, some may look like they're constant, but not a single number will stay constant for 1 year. So the life of some of these assets may be a few hours, okay? A few days, a few months, but definitely less than a year. Does it make sense? In other words, these numbers will change. That's what I'm saying. Okay? All right. So cash is the most liquid. That's why you must recall it comes first. Accounts receivable is credit extended to your customers. Most US firms, they sell on credit. Okay? So when you sell on credit, you haven't received cash, you haven't received a payment for that sale, so it will increase your receivables. And then inventory, whatever you have, in your inventory. So once again, this number, will will fluctuate throughout the year because you will take some of the inventory and sell it, okay, that will cause the inventory number to go down, but then simultaneously you could be buying some more inventory, so that number could be going up. So this is what we mean by, life is 1 year or less, that these numbers are fluid, these accounts are affected on a daily basis, So this is the total number. These are long-term assets, fixed assets. You may see property, plant, equipment, Fixed assets, life is more than a year, okay? Life is more than a year. And these are net fixed assets, net of depreciation, Okay? So this is something you may want to remember. Gross fixed assets. Gross means this is the price that you paid. This is the price, this is how much when you purchase these assets, maybe 10 years ago, maybe 20 years ago. So these are called gross fixed assets. Now, if you subtract accumulated depreciation, okay, this gives you net fixed assets, net. So what you see on that balance sheet, now, this is not to say that companies don't give you more details. Yes, this is an abbreviated. Okay, so generally you will see gross and you will see accumulated depreciation and net. So this is a very abbreviated balance sheet. Gross fixed assets minus accumulated over the years. Maybe you bought this machine 10 years ago. Okay, and over 10 years you were writing it off as the IRS required you. Okay, maybe you purchased for 1 million, and over the past 10 years you have written off half of the value, $500,000. So the remaining net fixed assets could be $500,000. Okay, so that's the relationship between gross and net. Okay, the third type of asset is intangible assets. I don't see any intangible assets here. All I see are two types of assets, current assets and fixed assets. So can anyone give me an example of intangible assets? Patents, trademarks, okay. These are, trademarks. Okay, you can sell a trademark, Okay. So those are examples of intangible. You may not see, it's not very commonly listed. Not all companies have intangible assets. Okay, on the financing side, so the funding side, this is the funding side. Likewise, we have three types of funding. One is short term. You call them current liabilities. Okay, as current assets have a life of 1 year or less, current liabilities also have a life of 1 year or less, and few days maybe. What are they? We start with accounts payable. These are vendor accounts. When you purchase raw material on credit, this account goes up. When you pay, this account goes down. So this is your vendor's account. Okay.